Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment and hit that subscribe button for all the latest content from us. A lot to talk about this week. We'll start out discussing Warren Buffett, another record cash level for Berkshire Hathaway. What are some of the reasons? We'll dig through that. The longest shutdown in history, likely to end this week. So we'll show the latest data on that. The highest beat rate since 2021, that would be S&P 500 earnings. Very strong quarter so far. Job cuts spiking in October here, biggest spike we've seen for October in over 20 years. Consumer sentiment nearing record lows, which is unbelievable to see with the stock market near record highs. Delaying the American dream. We've discussed this many times in the past year, but we'll talk about it again. We got new data here suggesting this is the case for the housing market. And we'll end with something positive, as we always do, and that would be the expectation that there will be no recession now in 2025. Big change from what people were expecting back in April. So let's begin. Why is Buffett holding so much cash? That is the key question here. Why are people asking it? Well, if you look at Berkshire Hathaway's cash pile, you can see huge vertical spike over the past 2 years, hitting another record high in the third quarter here, 382 billion. Huge increase over the past 2 years. And if we look at it as a percentage of assets, it's never been higher. 31% of their assets now being held in cash and short-term investments. So if we look at Berkshire, we look at their philosophy, and we ask the question, well, why are they raising so much cash? I think, first of all, you have to point to this philosophy from Warren Buffett, and I'll just read this quote here for you. Having loads of liquidity lets us sleep well during episodes of financial chaos that occasionally erupt in our economy. We will be equipped both financially and emotionally to play offense while others scramble for survival. So what he's essentially saying is they want to build up cash when times are good, and times are definitely good today, to take advantage of opportunities when things aren't so good. And they're not making any predictions as to when that will happen. I think they're simply saying that things are very good today. And if we look at valuations, things are in the upper level that we've ever seen historically. So their philosophy is that's the time you want to raise cash so you can take advantage of opportunities that will occur in the future. And looking at valuations here, hard to argue that they are in stretch. We've talked about the CAPE ratio ending October for the S&P 500 above 40. Only time we've seen that in history is 1999, 2000, and today. So is there an upper limit on this? No, we could surpass that 2000 peak of 44 that we saw during the dot-com bubble. But if Berkshire's looking at this objectively, they're likely saying fewer opportunities today because we're seeing valuations for many companies near record highs. And that includes Apple, which is continues to be their biggest holding, despite the fact they've sold it down over the past few years. Why are they selling it down? I would simply argue it's a different position when they bought it a decade ago. A decade ago, it was cheap on a valuation basis. It was trading at only a few times sales and 10 times earnings. Today, very different picture here, almost a record in terms of its multiple of sales, close to 10 times sales, and the P ratio at 36, EV to EBITDA 28. Historical average over the last 10 years is 18, and it was below 10 when they started purchasing this position. So looking at valuations, that's a clear indicator that likely this is a factor, I think, for Berkshire in terms of their cash holding. And also, if we look at sentiment, and this is something that Warren Buffett has been known for, we simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. And if we look at the market, and we're being objective here, very little fear out there. You would describe it mostly as a greedy situation, which is not surprising considering the gains that we've had over the past few years. And last week, I just outlined a few of these indicators. Active managers are now leveraged long in their equity exposure. And if we look at the percentage of bears in this Investors Intelligence Index, it's at the lowest levels we've seen in a long time, only 13% bear. So very few bears, many bulls. There's a lot of greed in the market, not a lot of fear, and that's not when Warren Buffett wants to be buying. He wants to be holding cash during those periods for when there is fear in the future. When is that going to occur? Nobody knows. But in order to take advantage of opportunities, this is their philosophy. You have to raise cash in advance. So let's talk about the longest shutdown in history, which is official. We're at the longest in history, but likely to end this week. And why is that the case? Well, finally, they have enough votes. They needed 60 in the Senate to pass this measure. They got the 60. They got 8 Democrats voting with Republicans to end the shutdown. So just a few procedural things they'll have to go through. They're going to send it to the House. It's expected to be passed there, and it should end sometime this week. If you're looking at the odds here from Polymarket, they're saying most likely will end November 12th to 15th. So sometime in the next few days, the government shutdown likely to end. And as we talked about, really no relationship between the government shutting down stock market performance. Stock market tends to be positive on average, positive again this time. So that would be the 7th in a row if this holds through the end of the shutdown, where the S&P 500 actually posts a positive return during the shutdown. And why is this the case? I've talked about this, but simply market is forward looking. They knew that this was going to come to an end, and then it's really about earnings, as I'll talk about later. And earnings have been very strong, and the projection is they're going to continue to be strong throughout the end of the year. But in terms of the shutdown, this is just a crazy thing that I think hopefully they will prevent this for the next shutdown. In terms of the impact on air travel, flights being canceled because the air traffic controllers not coming to work, they're not getting paid, they're not coming to work, and that's causing a lot of cancellations and delays and many issues in terms of travel. Hopefully that will end this week, but for the next time the government shuts down, why don't they pass a bill in the interim here to say that they will continue to fund air traffic control while the government is shut down? Why do we have to go through this every single time? And another suggestion would be look into privatizing air traffic control. If we look at the Canadian example here, it actually was executed very well. If we look at their example here, they created this private nonprofit corporation. It seems to have done what they wanted it to do, which is essentially improving the efficiency, lowering costs, and passing those on to the end consumers. It's actually, in terms of technology, far advanced to what we have in the US. So many different things there seem to be positive from privatizing this, even accident rates going down as well, which of course that's important as well. So why is this still part of the federal government? That is a question they should be asking here. And I think they should look at countries like Canada as a positive example of privatizing this, so this doesn't happen again in the future. We actually see technology improve in this area. So let's talk about the highest beat rate since 2021. S&P 500 earnings really, really strong, ahead of expectations here. Here's the stat here: 83% of companies that have reported have beat results so far. That's the highest beat rate since the second quarter of 2021. And this is really important here. The companies have reported earnings that are 10% above analyst expectations on aggregate. That is a huge, huge beat there. Highest surprise rate since the same quarter in 2021, meaning the second quarter of 2021. So it's been a long time, 4 years, since we've seen earnings growing this fast and beating at this rate. And let's just dig into some of the numbers here. The sales per share of the S&P 500, this is just continued to move higher throughout the quarter here. 5.7% now increase on a year-over-year basis. And if we dig into what's driving that, well, if we look at big tech, that's really been the leader here. So all of the big tech companies above that 5.7%. So that means that many other companies are seeing a slower rate of growth, but these big tech companies are really lifting that average here. Amazon 13%, Tesla 12%, Apple 8%, Google 16%, Netflix 17%, Microsoft 18%, Meta 26%, AMD 36%, and Palantir 63%. We don't yet have NVIDIA's number, but likely to be very, very strong. That's the expectation. So if we look at the bottom line, look at earnings, operating earnings, much better than sales. So we're looking at 24% operating earnings growth year over year, best we've seen since 2021. And what that simply means is companies are becoming very efficient, very rapidly here, whether it's due to AI or other technology or the fact that hiring has slowed down, but revenues are still growing. A number of factors likely causing this number to go up. But if we look at profit margins here, you can see 13.4%, almost a new record high in terms of profit margins for S&P 500 companies. And if we look at overall earnings last 12 months, this number has really improved over the last few weeks. $255 now in operating earnings for the S&P 500. That's a 13% year-over-year growth rate, highest we've seen since 2022. And 2022 was really coming out of that decline that we saw in corporate earnings after we had a downturn there in 2022 due to the inflation spike. So different scenario here, accelerating to the upside, beating expectations. So if we look at sentiment, why it's so strong today, this is a big factor, I think, driving it. The fact that the biggest companies are reporting earnings that are above even the high expectations that were there ahead of the quarter. So if we look at the jobs market, different story there. Job cuts spike in a red October. We got the latest data from Challenger, Gray, and Christmas here. And what they showed was 153,000 layoffs from U.S. companies in October. That was the most in over 20 years and a 175% increase on a year-over-year basis. So 175% higher than October 2024. And it was the most for any single month in the fourth quarter that we've seen since 2008. Of course, 2008 being in the middle of the worst recession since the Great Depression. So needless to say, this is an outlier here, something notable. We've been talking about higher rates of layoffs throughout the year and the fact that hiring has cooled off as well. But I think this number was surprising to the upside. We also got data last week out of ADP, the non-farm payroll report, again, being delayed because of the government shutdown. But ADP tracks private sector payrolls pretty well here. And what they showed, 42,000 jobs added in the month of October. You can see the slowdown a year ago in October, 221,000 jobs were being created. And if we smooth this out and look at a 3-month moving average, what you can see here is we're at the lowest levels we've seen since the 2020 recession. So 3,000 jobs on average being added over the last 3 months. So very slow rate of growth. Last October, we were at close to 200,000 jobs per month on average. So the question is, well, are we headed into a recession here? Are we seeing an economic slowdown? Or is it something else that's driving this lower rate of payroll growth? And Jerome Powell was essentially asked this question, and really two-part question. Number one, why is the job market weakening right now? And two, what will rate cuts do to help the jobs market? On the first question, he's essentially saying it's mostly weakening due to a decrease in the supply of new workers. And he's talking about labor force participation going down, which he's calling a cyclical thing, declining immigration, and other factors. And he's saying it's mostly a supply side story, but it's a little bit of demand as well. And so on the demand side, he's saying that's essentially what interest rate cuts will help with. And he's saying by cutting interest rates, that will help on the margin companies to hire more workers. That is the theory. I don't think there's a lot of evidence supporting that historically. I don't think any of these companies that are conducting layoffs are going to keep their workers because interest rates are 1% lower than they were a year ago. And I don't think they're going to go out and start hiring people because of that either. But that is the theory, and that's why they're likely to continue to cut interest rates. But the problem, of course, is that by artificially lowering interest rates, what you do is you drive up the demand for goods, which of course increases the rate of inflation. And we're seeing the inflation rate at 3%, highest in 16 months, and you have the Fed easing into that. So we haven't seen that in a long time. And when the Fed started cutting interest rates in September 2024, you had the CPI at 2.4%. Today it's 3%. So they've cut 150 basis points. Inflation is higher. And you can go back to this employment chart here. What has employment done during this period of time? It's gone down. So despite the fact that they've cut 150 basis points, labor market weakness continues. And their argument's going to be, well, we just haven't done enough. We have to cut interest rates even more. But the risk, in my view, is you're going to drive inflation up higher, and people are going to be without jobs and now facing higher prices as well. So if that transmission mechanism isn't there, and I am questioning it, whether lower interest rates actually lead to a big spike in employment, if that situation does not exist, then simply you're creating more inflation for a period of higher unemployment, and that's not a very good thing. But in terms of the market, what are they expecting for the December meeting? Right now, they're saying about 60% odds of a rate cut. So certainly not a done deal, not at 90% plus, but a lot's going to change between now and then in terms of the data. With the government reopening, we're going to get a lot of that data that has been stalled, particularly the employment data. We have another inflation data point this week that we're supposed to get. We'll see if that's delayed. So a lot can happen between now and then. And there is some dissension in the ranks. Some people arguing that the Fed should be more aggressive, cutting 50 basis points, and others saying the Fed should slow down here and hold rates where they are. So we'll see what happens in the next few weeks. But right now, market's saying one more rate cut at the last meeting of the year. Let's talk about consumer sentiment nearing record lows, which is crazy to see with the stock market at record highs. And what we're talking about here is this University of Michigan Sentiment Index. And this goes back to the 1950s. And this is actually now down to 50.3, which is the second lowest reading in the survey's history. Only June 2022, when we had inflation at 9% in the US, so highest inflation in 40 years. That was the only time it was lower than today. And previous to that, you would only see these types of low levels really during recessionary periods. So 2008, 2009, 1990, 91, the 1980s, double dips recession in the early 1980s, and the 73, 75 recession. Back then, you saw sentiment at very low levels. You also saw, I would say, stock prices going down during this period of time. So very unusual stock market at all-time highs, essentially, and sentiment near record lows. Even in 2022, we were in the midst of a bear market back then, so you had stock prices declining. So this is really the historical outlier in terms of sentiment, and people are expecting higher unemployment and higher inflation. We've talked about that. That's the expectation, and it seems to be getting worse every single month. Will they be right about it or wrong about it? We don't know. But for the time being, the stock market's behaving as if the consumer is not really acting on that negative sentiment. And if we look at retail sales, I mentioned this last month, 4.8% increase over the past year. We don't have the updated data here because of the government shutdown, but retail sales still overall pretty strong. And if we look at the S&P 500 sales number that I talked about earlier, beating expectations. So it seems like the consumer is still spending despite their negativity about the environment that's out there. So a very unusual situation. And some people are trying to say, well, it's simply a bifurcated consumer here, where some of the consumers are spending and happy about the future because they own stocks and stocks are going up. So we can see the difference here between the biggest stockholders and non-stockholders. So non-stockholders at record lows in terms of sentiment, and the biggest stockholders, their sentiment is materially higher, but I would still say much lower than where it would have been historically. So it doesn't completely explain it in terms of the your stock position, but it does seem to be a difference there. I'd say another thing to look at is to look at people's incomes, and we're continuing to see the highest income earners in the U.S. really drive more and more in terms of spending here. This was a chart that really illustrates that. We're looking at half of all consumer spending coming from the top 10% of income earners in the U.S. That's up from about a third in the early 1990s. So a big difference here depending on your income level. And why would that be the case? Well, two reasons. Number one, higher income people own more stocks, so they're feeling better about that in terms of the stock market being at record highs. And number two, inflation does not impact higher income earners as much as lower income earners. We talked about that. Inflation really a regressive tax on lower income earners, and with inflation becoming more and more of an issue in terms of consumers' fears, that would make some sense there as well. Where are we starting to see some of a pullback in terms of spending and a pushback in terms of those higher prices? Well, we got some data in terms of the restaurant stocks. If we look at Chipotle, very interesting earnings call where they're talking about young people and low income consumers really are eating fewer burritos essentially. And so Chipotle is not cheap anymore. Maybe it used to be $10. Now you're looking at $15, $16 to eat lunch there. And that's a big change for people over the past 5 years. Their incomes haven't gone up that much. And if we're looking at as a percentage of their sales, incomes below 100,000 represent 40% of the chain sales. So that's going to hit that particular group much harder. And what the CEO is saying, we're losing them to grocery and food at home. So where can you save money if your budget is becoming tighter because inflation is going up? Well, simply not eating out as much, cooking more food at home will definitely be a way to save money. And what they're forecasting for this year is for sales to decline in the low single digit range. And for Chipotle, that's a big change because this is a hyper growth company for which really has never really had a downturn in sales in its history. And they're seeing finally a slowdown here. And looking at the stock prices, not just Chipotle, I'm putting here Shake Shack and Kava into the group as well. Negative 28% return this year for Shake Shack. Chipotle down 49% and Kava down 57%. So is this an early warning sign or is this just a one-off? Remains to be seen, but definitely notable, I would say, that consumers are really starting to push back again against some of these big price increases that we've seen in recent years. So let's talk about delaying the American dream and why is it being delayed? Well, basically, the housing market has never been more unaffordable than it is today. 57% affordability gap. This is between the income you need to purchase a home and people's actual incomes. So huge spread. We've never seen it this wide, even going back to the housing bubble back in the mid 2000s. And what this is causing is people delaying the purchase of their first home. We could see that in the latest data from the National Association of Realtors here. 40 is now the median age of a first-time home buyer in the U.S. Record high, up from 31 a decade ago, and 21% of all U.S. home buyers are now first-time home buyers. That is also a record low, down from 50% back in 2010. So we've gone from half of all home buyers 15 years ago to about a fifth today. And so what are some things we could do about this? People often ask me, is this just inevitable? How did we get here? Well, many different things could be done to improve the affordability picture. You just have to have the will to do it. First, you have to look at, well, why did we get here? Why do we have the most unaffordable housing market in history? And number one would be what we did in 2020 and 2021 in terms of printing money, in terms of the money supply, and what the Federal Reserve did in terms of interest rate suppression and buying mortgage bonds. So how do you fix the problem? Well, you control that money supply going forward. You could put a limit on growth based on GDP, many different things you could do, but you don't want to see ever again that 40% increase in the money supply that we saw in 2020 and 2021. That was the primary factor driving up home prices to unaffordable levels. And in terms of the Fed, this would take Congress, an act of Congress, but I would 100% say do not give them the ability to reflect on interest rates. They should have no ability to control interest rates. The interest rates should be controlled by the free market, and they certainly shouldn't be allowed to buy mortgage-backed securities. So back in 2020, 2021, we already had record home prices. We already had low affordability in the U.S., and the Fed went ahead and kept interest rates at 0% for far too long. And they also bought trillions of dollars in mortgage bonds, driving interest rates to artificial lows below 3%. And that essentially froze the housing market for a generation of buyers. So don't allow them to do it going forward. I don't hear anyone discussing that, but that would be a big step in the direction of affordability. Fannie Mae and Freddie Mac, these government-sponsored entities, end them, wind them down, because guaranteeing all of these mortgages is just creating more artificial demand in terms of the market. They now control 70% of all mortgages, Fannie and Freddie. So I would slowly privatize them or wind them down. We need more development in the U.S. You should be encouraging that. We can encourage it in many different ways. Federal and state-owned land, excluding parks, I think should be opened up for residential development. And finally, you have the fact that you have this extra demand coming from corporate investors and foreign buyers. And until home prices are affordable, I think you need to put a high tax on these buyers to reduce the demand from them. So many different things you could do in terms of making the housing market more affordable. Is there the will and the desire to actually do these things? I'm not sure, but you could very easily do this. It would make the housing market more affordable. You would see prices really be more reflective of people's incomes and not being pushed to these artificial extremes if you did any one of these things. So you don't have to do them all, but if you did just a few of them, would make a big difference. But you need the will to make housing more affordable. You have to think about the younger generation and the harm this is doing in terms of them delaying family formation and everything else. So it requires having a really perspective on what will happen as a country if we don't fix this affordability crisis. It's not a good thing to have home prices diverge from fundamentals to this great of an extent. Encouraging a housing bubble, I would say, is a terrible national policy. The Federal Reserve and the federal government have really encouraged this policy over the last 25 years. And when home prices reset and they came back down following the global financial crisis, they became affordable again, but we quickly went back to the old playbook, which is leading us to where we are today. So hopefully we'll see some of these things enacted. Hopefully we'll see the housing market become more affordable in the coming years. Okay, we'll end with something positive, as we always do. That would be no recession in 2025. If we look back in April, that would have seemed like a crazy thing because we were in the midst of a bear market. We had the whole tariff tantrum situation, and I did this poll on X asking, will the U.S. economy fall into recession in 2025? 67% said yes, just 33% said no. And what a difference. We're talking about 7 months later here, and only a few percent, if we're looking at the betting markets, poly markets, saying 4% chance now of a recession in 2025. So obviously another year of expansion, very good thing. Hopefully this continues. Okay, let's end it right there. Have a great week, everyone. Thanks for watching The Week in Charts. If you're watching this on the YouTube, hit that subscribe button. I'll see you next time on The Week in Charts.